Hey, in today's video, we're going over 10 required minimum distribution frequently asked questions to help with your retirement planning. So maybe you just got some questions, or maybe you're getting close to your RMD age. Stick around. You don't want to accidentally mess anything up. Hey, this is Mel Stubbs. I'm a financial planner with Christy Capital Management. We're helping federal employees plan for a better retirement. If you need individualized help, go to christycapital.com and click Talk to an Advisor. Today we're talking about 10 RMD FAQs. First, when do RMDs start? It used to be age 70 and a half, but now, as you can see right here, if you were born July 1st, 1949 to December 31st, 1950, your RMD age would be 72. If you're born January 1st, 1951 to December 31st, 1959, your RMD age will be 73. And for anyone born after January 1st, 1960, your RMD age will be 75. The second frequently asked question are, how are RMDs calculated? The uniform lifetime table is the most used. You can see here that there's an age and then there's a life expectancy factor. And so you take your December 31st end of the year balance of your traditional retirement account and you divide by this factor. Let's say that you've got $1 million of traditional IRA and you're 75 years old. You would divide by 24.6 and come up with a $40,650 RMD. That's the amount that you'll be required to withdraw from your traditional account. You can see that each year the life expectancy is going down, and the lower that number, the larger your required minimum distribution will be. They also have a joint life expectancy table. It's used if your spouse is your sole beneficiary and your spouse is more than 10 years younger than you. So with this chart, you take your age and your spouse's age and you kind of meet in the middle to find that factor. And you do this same thing where you take your IRA balances as of December 31st of the prior year and you divide by this factor. Now notice here on the joint life that these numbers are larger, and the larger the factor, the smaller the required minimum distribution. Most people would prefer the RMD to be as small as possible. So if that's true for you, then you may want to use this joint life table if you're able. The third frequently asked questions about RMDs is, do I have to take an RMD the first year? You don't have to take your first RMD by December 31st because you actually have until tax day in April of the next year. So if you do wait until, let's say, March or April to take the previous year's RMD, you will have to take 2 RMDs in that second year. After the first year, it is a December 31st deadline. So depending on your income situation, it may make sense to delay and have 2 RMDs in the following year, or it may make sense to not delay and go ahead and take one this year and then take one next year so that you're not doubling up in year 2. The fourth frequently asked questions is, are there required minimum distributions from Roth IRA or Roth TSP? And the answer is no. You only have to take RMDs from traditional retirement accounts. And the theory behind that is that the IRS has not taxed your money yet, and so they force you to start taking money out of the taxable money, but they don't force you to take money out of the Roth. And we have lots of videos on here about how to reduce RMDs, and one way to do that is by sending money to Roth each year, year after year, by doing Roth conversions. Some people want to do this effectively enough that so when they show up at RMD age, they don't have any traditional accounts, which means they wouldn't have any required minimum distributions. This is one advantage I think Roth has over traditional in that they don't force you to take money out. The fifth frequently asked question is, can I aggregate my RMDs? And that's just a fancy term to say, do I have to take an RMD from each individual account I have, or can I just add them all up and figure out the total RMD and take it from that one account? And the answer is yes and no. With IRAs, yes, you can aggregate. You don't have to take a minimum distribution from every IRA that you have. You can add up the total, figure out the amount, and then take that distribution from whichever one IRA you want to. Keep in mind, this does not work for spouses. The husband can aggregate his account and take one RMD, and the wife can aggregate her account and take one RMD. You can't take all the RMDs for both husband and wife only from the husband's account, for instance. Can't do that. Remember, the I in IRA stands for individual. However, with TSP, you do have to take your RMD straight from TSP. You cannot add the TSP's December 31st balance in with your other IRAs and just take one large distribution from your IRA. Employer-sponsored plans have to be done separately. Now, we are generally recommending that people consolidate their tax-deferred accounts to not have so many. And this is definitely something that we help clients with. We help make sure that you're taking the right amount from the right account so that you don't get penalized by the IRS. Consolidating accounts just to have less in number and to have them kind of consolidated in one location can help make things easier. RMD, frequently asked question number 6. What happens if I don't take an RMD by the deadline? Well, if an account owner fails to withdraw the full amount of the RMD by the due date, the amount not withdrawn is subject to a 25% penalty that can possibly drop down to 10% if the RMD is corrected in a timely manner, which the IRS says is within 2 years. Now, these are better penalties than what they used to be. It used to be a 50% penalty. So there's a penalty for not taking the correct amount out by the deadline. You may want to work with somebody that can help make sure that you avoid these penalties. Now, the 7th frequently asked question is, can RMDs be Roth converted? Or can an RMD be rolled over into another tax-deferred account? And the answer to both of these is no. You cannot Roth convert your RMD. Now, in our previous example where we did some math and we figured out the person had around a $40,000 RMD for our 75-year-old, you cannot convert that $40,000. You must take that distribution where the $40,000 leaves the tax-deferred account, and it either goes to a checking account or to a taxable account somewhere, but it has to be taken out. You're going to get a 1099 for that $40,000. If you want to do a conversion, you can Roth convert in addition to that, but you cannot Roth convert that $40,000. Also, you can't roll that $40,000 into another tax-deferred account somewhere else and call that your required minimum distribution, because rolling one IRA to another IRA is not a taxable event. Most of the people that we're helping are either sending the required minimum distribution to their checking account, or they're sending it to another investment account that's an after-tax investment account where the earnings are going to be subject to capital gains, or they're doing a qualified charitable distribution, and we'll talk about that next. So the 8th frequently asked question is, can you give your RMD away and have it not be taxed? And the answer is yes, and we just mentioned it. It's doing a qualified charitable distribution. Right now, the limit is $105,000 a year, and that's going to be adjusted for inflation each year. And these gifts are above the line deductions on your tax return, which means there's no need to itemize your deductions on your taxes. Right now, if you give money to charity, you have to itemize to get credit for it. If you itemize your deductions and they're not higher than whatever your standard deduction would have been, then you usually take the standard deduction because that's more advantageous. But in essence, you're not really getting to write off your charitable gift. So what's great about this being an above the line deduction is that it lets you take the standard deduction and take this QCD deduction. Now, there is a distinction here, and it's that the TSP does not let you do qualified charitable distributions. You would have to move money from TSP to an IRA and make the gift from your IRA. If you're already charitably minded, you're already giving money away, this could be a great way to potentially make the gift a little more tax efficient. You do have to be 70 and a half years old or over to do a qualified charitable distribution. So if you're already taking an RMD, then you would already be above that age. The 9th frequently asked questions is, what option does your spouse have with inheriting your IRA? If we're doing RMD planning, and you should be, what should your spouse do when they inherit your money? Well, they have several options. They could just take a large distribution that would be fully taxable, and if the goal is minimizing taxes, they probably don't want to do that. They could roll it into their own account, or they could open up an inherited IRA. So let's discuss the advantages of each of these. Let's say that the IRA account holder had already begun taking RMDs, and you, the spouse, are younger than they were, and you're not old enough to be forced to do RMDs yet. If your spouse passes and you roll the money over into your own IRA, you would not have to take RMDs because you're not old enough yet. That move would minimize RMDs and thereby minimize taxes. If you move the money over to an inherited account, you would have to continue the RMDs because your spouse already started them. In this case, to minimize RMDs, you may want to roll the account over into your personal account. And when I say personal account, I mean your personal IRA account. Is there a benefit of opening an inherited IRA? If you are already receiving your own RMDs, but your spouse was not, rolling it to your own IRA would force you into taking RMDs. If you put that money in an inherited IRA, it would in essence delay RMDs until the year that your spouse would have turned on their RMDs. If you're trying to minimize RMDs, that would do it. Another benefit of an inherited IRA is that if you're under the age of 59 and a half and your spouse dies and you put the money in an inherited IRA, you can access that money without a 10% penalty. Since you're under 59 and a half, if you roll the money into your own personal IRA and then you needed to access some of the money, you would be under the age and therefore subject to the 10% penalty. There is not a penalty for accessing money from an inherited IRA, so that could be beneficial. A different reason why you may want to put the money in your own IRA is that if you want to Roth convert it. You cannot Roth convert inherited IRA. You can Roth convert your own IRA. Getting this money moved to your own IRA for this reason may be helpful. Can you move some of it to your own IRA so that you can Roth convert, and move some of it to an inherited IRA so that you can access the money prior to age 59.5 if needed? Yes, you can. The takeaway here is that the rules are kind of confusing, and working with a professional could be helpful. Postponing taxes may be helpful, but also deciding when to pay the tax, as maybe 1 year you have a higher income and you don't want to take an RMD, and other years you have a lower income and you would like to take it. You don't want to be forced to take money out during high income years if you don't have to. Knowing these rules and using them correctly can be beneficial. The last frequently asked question is, do your RMDs stop when you pass away? If you were already receiving RMDs and the person inheriting the money has to open up an inherited IRA, then there's a 10-year rule. The beneficiary has 10 years starting on the year after death to get the money out of there. Now, to even out the tax payments, let's say you took an even portion to withdraw as even as you could over 10 straight years. That distribution amount would still be higher than what the original RMD would have been. We talked earlier about a spouse that's younger that does not have RMDs can inherit and roll it into their personal IRA to stop the RMDs. But if somebody inherits, whether they're a spouse or a non-spouse beneficiary, and they move it to an inherited IRA, there's going to be a 10-year window, which means the RMDs don't stop when you pass away. Actually get worse because the minimum amount will now be a higher percentage than what you would have been taking if the owner has kept living. Now, with all these rules, there's a chance that you can mess them up. And when I say mess them up, I mean paying a penalty when you ordinarily wouldn't have had to, or continuing an RMD when you don't want to and you could have gotten around it if you knew the rules. Letting taxation happen by default can mean, in some cases, that you're going to overpay. Some of these things can be planned in advance to give you a more positive outcome. If you need help, go to ChristyCapital.com and click Talk to an Advisor. We'd love to help you. If you want to watch another video right here about how to reduce RMDs within your TSP, most people don't like to be mandatory to anything. And so if you want to take money out, that's fine, but just don't force me to. So if you want to reduce the RMDs in your TSP, check out this video right here. My name is Mel Stubbs. I'll see you on the next video.